Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Currency Analyst at MUFG. It's Friday, 14th July 2023, and joining Lee to pose some questions on the financial market themes for the week ahead is Jack Greenslade from the Global Customer Marketing Group. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi Lee, how you doing?
I'm good, thanks. How are you, Jack?
Yeah, good, thank you. We've had quite a busy days calendar this week, and obviously we've seen some big swings in the FX market. What do you make of some of the moves that we've seen?
Yeah, I guess the big move that we've seen has obviously been the dollar, where we've seen a further leg lower, kind of extending the sell-off that started late last year. And yeah, obviously the main trigger for that has been evidence of slower inflation over in the US. We've had much weaker CPI and PPI reports this week for the month of June. And to us, the move in the dollar makes sense. Obviously, the Fed themselves have signaled very clearly recently that they are focusing on the core measures of inflation to see if those are slowing. And if we look at the super core measure of inflation in the CPI report, that remained weak for the third consecutive month, marginally negative actually month on month in June. So that's obviously a very encouraging development for the Fed and should give the Fed more confidence that they're close to the end of their hiking cycle and that they've done enough in terms of raising rates. So to us, we still think the Fed will do one last hike later this month. But beyond there, we don't really see strong justification for further Fed hikes. We're expecting inflation to slow further in the coming months, and by the time we get to that September FOMC meeting, we're more confident that the Fed can pause their hiking cycle. And obviously markets as well are forward-looking, and obviously once the tightening cycles come to an end, markets are starting to price in more rate cuts next year from the Fed. See, if inflation continues to fall closer to 2%, then we don't think that the Fed needs to keep their policy rate at 5%, and there will be room for them to start cutting rates next year, which is starting to weaken the dollar as well.
Okay, and just looking at the UK in particular, we haven't seen the same sort of slowdown in inflation versus that we've seen in the US. What's keeping inflation so sticky in the UK? And when do you anticipate inflation coming down in the UK?
Yeah, that's correct. Certainly, if you look at inflation in the UK, whether it's food inflation, energy inflation, or core inflation, all three of those measures are still higher than they are over in the US. So I think certainly the impact of lower energy prices and food prices that we've seen in the wholesale markets, it's taking longer for those to feed through into the CPI figures in the UK. We do think ultimately that will happen. It's just happening with more of a lag. So we would anticipate food and energy inflation will fall more sharply over the next kind of 6 to 12 months in the UK, which would be a positive development, would help to bring the headline rate down to more comfortable levels for the Bank of England. And that as well should help next year in terms of the wage setting process. If headline inflation is a lot lower, it should help to put a dampener on wage growth next year. But that's certainly an area of concern in terms of inflation persistence in the UK. Like the Bank of England have certainly become more concerned that we've seen very strong wage growth recently in the UK, and that's making them more fearful that it will be more difficult to get inflation down on a more sustained basis. So one of the problems we've seen in the UK is the tightness in the labour market. We did see initially during the recovery phase from the pandemic that labour force inactivity rose quite sharply as more and more people left the labour force because they had long-term sickness. But what we've seen recently over the last sort of 3 to 6 months is that actually that activity rate has started to pick back up again. So more people are re-entering the labour force. So that as well provides us some reassurance that the labour supply situation is starting to improve in the UK as well, which would help to ease some of the upside risks for wage growth going forward. So kind of putting it all together, obviously the UK at the moment stands out clearly as one of the worst economies in terms of the mix of low growth and very elevated inflation. But we do think on the inflation side of things, that situation will improve over the next 6 to 12 months.
And of course, markets are implying a further 120 basis points of tightening by the BOE by 2024. Do you think this is overdone or justified?
Yeah, I think on balance, we would say our base case is that we're looking for the Bank of England to raise rates up to say closer to 6%, rather than 6% plus, which to us looks more reasonable at this stage. Certainly the probability of them doing another 50 basis point hike in August is high now after we had another strong wage data over the past week or so, which would then get us up to 5.5%. And from there, we potentially could have one or two more hikes towards the end of this year. But for obviously rates to go even higher than 6%, towards 6.5 to 7%, that obviously would be more of a kind of worst case scenario where inflation remains very elevated. We don't see inflation coming down, and that the Bank of England becomes more and more concerned that there's a serious inflation problem and that they have to act to try and slow the economy more sharply. I think that would obviously be a worst case scenario for the UK economy if they were forced into more aggressive hikes than what's currently priced into the curve. See, for the pound, as we've seen, pound has benefited this year from the resilience of the UK economy, which has not fallen into recession as many people had feared, and obviously from the combination of higher rates in the UK as well. But those factors have helped to strengthen the pound. I think near term that trend can continue. We've obviously seen cable now above 130. Potentially that could extend up into the mid 130s. Certainly, if the broader dollar sell-off was to continue, and the Bank of England raise rates well beyond the Fed in this cycle, then it would certainly justify a higher cable rate. The problem being that further down the road, if the Bank of England does raise rates up to those higher levels, we would expect then to see more of a negative impact on the UK economy from higher rates. And I think when evidence of that slowdown starts to emerge, you would anticipate that could be the turning point, which triggers a sell-off for the pound.
Yeah, absolutely. And just looking ahead to next week, the Fed are obviously entering their blackout period ahead of the upcoming FOMC meeting. What do you think will be the key focus for FX markets?
Yeah, next week, I think there are two kind of main focuses for markets. One, at the start of the week, will be the release of the latest GDP and monthly activity data from China. We're expecting that to provide confirmation that China's recovery has lost momentum in the second quarter, and markets now obviously fully anticipating that slowdown, and they're looking now for direction from policymakers over in China. So we've seen the central bank there start to cut rates to provide more support for growth. But I think for markets, they really need to see more kind of convincing stimulus measures coming from the government as well to try and provide more confidence that the recovery can regain momentum in the second half of this year. That's going to be important for Asian currency performance and also broader kind of commodity currency performance going forward. And then secondly, inflation as well is going to be another big focus still for markets. Unsurprisingly, we have a number of CPI reports coming from New Zealand, Canada, the Eurozone, Japan, and the UK. Like I was saying, the UK inflation report next week will certainly get a lot of attention. I think we've had 4 consecutive months now of stronger than expected CPI data coming from the UK, and like I say, that has encouraged the UK rate market to price in aggressive hiking from the Bank of England. So we obviously need to see what happens in the week ahead. If there was to be another upside surprise, then like you say, the market could move to price in an even higher peak for UK rates and pushing the pound to even stronger levels. Whereas obviously vice versa, if inflation does finally come surprise to the downside, that could trigger a squeeze on some of those long positions that have been built up recently in the pound.
Okay, brilliant. Thank you very much, Lee, and have a great weekend.
Yeah, you too.
Thanks a lot.
Thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.